Good afternoon, everyone, and welcome to our fourth installment of our American Rescue Plan video series. And today, in a moment here, I'll be joined by Paul Coleman, CFP, a financial advisor here at Level Financial. I'm Mike Hebron, the COO of the company. And today, we're going to be talking about child tax credits and child and dependent care tax specifics. So Paul, let's have you jump right in here and let's start the conversation. What's going on with child tax credits in the American Rescue Plan?
All right. So fun stuff for individuals or married couples that have children. So in the past, the child tax credit, which was increased from $1,000 to $2,000 back in December of 17 when they passed the Tax Cares and Job Act. So it was a $2,000 credit, and you would be granted that for dependents on your tax return who were under the age of 17 as of December 31st of that tax year. So right now we're in the 2020 tax year, or excuse me, we're in the 21 tax year. We're filing our 2020 taxes. So people on there that had children who did not get older than 16 in 2020 will be eligible for a $2,000 child tax credit. They've increased this significantly for 2021. So for children under the age of 18, please note that that is 1 year longer than it used to be. You'll get a $3,000 credit. That's up from $2,000. For children under the age of 6, so 5 and younger, as of December 31st, 2021, will receive $3,600 per child. So that's a vast increase, significantly more money that you are eligible for. I say eligible because there are phase outs based on your income. So if a single filer crosses $75,000 of AGI, adjusted gross income, which essentially is just gross income, they will start losing some of that child tax credit. And I believe it actually phases out at $50 per $2,000. I'm sorry, $50 per $1,000 past that income limit. So that was single filers. For those filing head of household, the phase out starts at $112,500. And for those married filing jointly, the phase out starts at $150,000 of AGI. And the phase out is the same. It's $50 per 1,000. And I hesitate when I say that because I'm trying to look at my notes, and boy, there are a lot of numbers coming out of this American Rescue Plan. So it's important to note that the child tax credit was $2,000, and now it is potentially as high as $3,000 or $3,600. So there's an additional $1,000 to $1,600 per child, depending on the age. That is temporary and is for the 2021 tax year only. The phase outs that I referenced, that $50 per 1,000 over the income limits, it affects the additional amount, but not the base amount. So important to understand that you could potentially, if you're married filing jointly and you're earning more than $150,000, you could potentially earn so much that you phase out that entire additional amount. You would still be eligible for the base amount, also subject to certain income limits. So the child tax credit that existed prior to this American Rescue Plan still had phase out limits, income limits. They were $200,000 for a single person and $400,000 for those filing jointly. So up until those limits, you would still be eligible for the $2,000 credit. Another huge change here, previously, we're talking $2,000 per child. $1,400 of that was refundable, which means that if your child tax credit ended up being such a large amount that it was greater than your tax liability for the year, the government would actually refund the difference back to you, but only to the tune of a maximum of $1,400 per child. This year, fully refundable. It is feasible that a family of 4 could be seeing in excess of $12,000 of credits. And if they're a modest income, they could be fully refunded that entire amount. essentially a very large fourth stimulus check. So the next piece that I want to get into is that this 2021 child tax credit, which you would normally not enjoy the benefit of until you file your 21 tax return in the spring of 22. For 2021 only, the IRS will pay you up to 50% of your estimated child tax credit for 21. And how they're going to do that is they're going to take a look at the most recent tax return on file. That's going to be the 2019 or 2020 return. They're going to look at your income. They're going to look at the number of the children on that return or dependents on that return and their ages. And they're going to say, we believe this taxpayer will be eligible for X amount of child tax credit in 21. And starting on July 1st and going monthly through December 31st, we will pay them half of that child tax credit. So how that works is if you ended up being eligible for a $6,000 credit, or it appeared you would be, you would get 50% of that, which is $3,000, spread between July and December, which is 6 months. You would be getting an additional $500 per month starting in 2020 in July. So the government is doing everything they can to expedite these credits and make sure that that money is in your pocket when you actually need it, which is when you may be out of a job or when we're working our way through a pandemic. It is also important to note here that there is a potential clawback of that child tax credit. What that means is they're going to prepay you starting in July for the estimated child tax credit. And if it turns out that when you go to file your 2021 tax return, again in the spring of 22, that you earned too much income to be eligible for how much child tax credit they paid you, you will end up paying it back via an increased tax liability on that tax return. So important, if you know your 2021 income is going to be significantly higher than the income the IRS is using to estimate your estimated credit, you may not want to spend that money because you might end up owing it come April of 2022.
Okay, so it sounds like obviously the government is doing everything it can to get cash into people's hands right away, obviously to stimulate the economy. So let's talk a little bit about child care and dependent care tax credits for 2021 and how those are going to work.
Yeah, definitely. So important to know, these are different credits, although the language is incredibly similar. So the child and dependent care tax credit used to have a maximum amount of eligible expenses that you could potentially use in this crediting formula. And it was $3,000 for filers with one child and $6,000 for tax filers that had two or more qualifying children. And a qualifying child was a child who was under the age of 13 as of 12/31 of that tax year. Moving forward, they have increased the amount of eligible expenses that you can use. It will now be $8,000 for one child and up to $16,000 for two or more qualifying children. This is more than double what this credit used to allow as eligible expenses. Further, and this is where you get some really big numbers, the crediting rate, which used to be a maximum of 35%, will now start at 50%. And that phase out range that we talked about that started at a very low income of $15,000 will now start at $125,000 of AGI, regardless of filing status. So a significantly larger number of taxpayers with children or dependents will be seeing a much larger credit for three reasons. One, you have a much higher phase out. Two, you have a much higher crediting rate initially. And three, you have a much higher amount of eligible expenses that you can claim. I should note that the phase out of the crediting rate on the new child and dependent care tax credit for 2021 is the same as it used to be. That drops from 50%. It drops by 1% per $2,000 you're over that new phase out range of 125 grand. Another difference, and I know we're getting pretty complicated here on this one, a lot of numbers. Another big difference is that in the past, very high tax filers could still potentially be eligible for a little bit of this refund or this credit, excuse me. Now, those tax filers earning more than $400,000 AGI, regardless of filing status, will see their crediting rate, which used to have a floor of 20%. They will see their crediting rate drop again by 1% for every $2,000 they're over that 400. That means that a single person, head of household, or married filing jointly individuals who cross $440,000 of AGI will have a 0% crediting rate and therefore a $0 credit. So the big difference there is those with more modest income could see a tremendously larger child and dependent care tax credit in 21. And those with very, very high incomes could go from having a small credit actually down to nothing.
So let's finish up here then with, let's talk a little bit about some of the planning opportunities that these types of credits can present for our clients. What do you see here with this part of the American Rescue Plan?
Yeah, a little bit in the planning opportunities. I do want to note, I forgot to mention, this child and dependent care tax credit, just like the child tax credit, care credit, fully 100% refundable. So if you have a credit that is much larger than your tax bill, the IRS will show you that via your refund. This could be a lot of money for a lot of American families that need help in this difficult time. So on to the planning opportunities. If you watched our other video, the stimulus checks and some of the planning opportunities there, it's similar in that we are currently in the 2021 tax year, and you have the ability to somewhat control your income that will be shown on this tax return. And the most common ways to do that are to increase contributions to your employer provided retirement plan. That'll be the 401k, 403b, 457, deferred comp, et cetera. The maximum on that is $19,500 for those up to age 49, and for those age 50 and older, you can do up to $26,000. So if you're close to the line where you may see one of these credits starting to phase out, and there's room to contribute more to your retirement, it certainly doesn't hurt to pay yourself by increasing your retirement contributions closer to the max, lowering the AGI that will be showing on your tax return, and then receiving a larger child tax credit when you file your 21 tax return. The other one to consider is if you happen to be somebody that's over age 70.5, you're allowed to do something called a qualified charitable distribution, often known as a QCD. You would not normally consider this until you're actually age 72 or older. The reason here is the IRS is going to require you to distribute money from your pre-tax account, your IRAs, et cetera. Those RMDs could potentially, or they will, push up your income, and they could potentially push it over some of these phase-out ranges we've talked about. Now, if you're 72 and you had a qualifying child, which I know is rare, but it's possible, or if you had a qualifying dependent, which is more common, and you're about to be pushed over these phase-out ranges by your RMD, your required minimum distribution, you could consider a QCD, which is a charitable contribution directly from your IRA to the charity of choice. You could consider that strategy. It will wipe off whatever dollar amount you contributed to that or gave to that charity. It'll take it right off the top of your tax return, lower your AGI, and increase your chances of being eligible for some of these credits.
Okay, wow. Well, no shortage of numbers in this presentation for sure. And hopefully we've encapsulated some of those numbers in some of the slides we put up on the screen along the way. But if you have questions about any of the information we just provided or anything in the American Rescue Plan, we really urge you to give us a call. Call us at 716-634-6113 and ask to speak to an advisor. And you know, maybe we can help you out and answer some questions for you. You can also subscribe to our YouTube channel to get our continuing series of videos about the American Rescue Plan. We have other videos coming out every few days. So until then, thanks for joining us. Thanks, Paul, for your great information. And until next time, we'll talk to you soon.
Thank you.